Welcome in, folks. It's a buy one, get two free here today. 3 videos up for me to react to. It's interesting. I woke up this morning, looked at my stocks, and my best performing stock was a company named Nordstrom. And I was like, that's strange. Like, it was up like 7% or so. Well, here today, Macy's announced basically they got a $5.8 billion buyout offer. So this is huge news in the retail landscape. We'll react to this video, kind of hear about this. I kind of want to talk about my opinions and perspectives on that. Then we're going to get into this one. JP Morgan's Bob Mitchell. The labor market's cooling off. Hear what he has to say. And then the one I'm looking the most forward to is this one. Morgan Stanley's Mike Wilson is bearish on stocks for 2024. Mike Wilson has been bearish on stocks for quite some time. And so he's remaining bearish into 2024. And it's interesting. I looked at the comments. I was just curious, like, what people were commenting. And, it's just crazy. The top comments, he has no credibility. Why hasn't he been fired? If only I listened to him a year ago, I would have missed out on a 25% run. And it's so funny because if we go back to this time last year, Tom Lee, who's always bullish on stocks, would have been getting those same exact comments. People just dogging him, making fun of him. Why they keep having him on TV? He doesn't know what he's talking about, right? Now Tom Lee is looked at as like genius, and Mike Wilson at this time last year was looked at like as a genius, right? And Tom Lee was looked at as people that said he had no credibility, no this and no that, and it's just funny. It reminds me of a scene in the Gladiator movie when there's a scene and he says, what does he say? He says, the crowd is fickle. The crowd is fickle. It's funny how that works. Appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. And let's go ahead and jump into this.
Have reportedly offered to buy retailer Macy's for $5.8 billion. That's according to people familiar with the situation. The offer values the retailers at $21 a share. You can see the stock all the way up to $20.80 at this point. It's a gain of 19.6%. Joining us right now is Dana Telsey. She's Telsey Advisor Group CEO and Chief Research Officer. And Dana, what do you think? Does this make sense to take it private?
An offer does make sense. It's just who's the right buyer for this offer. We've all seen what's happened before, whether it's real estate or it's splitting off e-commerce. But what's inherent about Macy's, they're close to the customer. You look at their doors they have, and they've pruned their doors over the years. They're now at around 784 in total. And who wants to be closer to the customer? It's got to be a strategic, I think, that makes sense.
Okay, so if you were to take this company private, are you doing it because you want to be able to do things that you couldn't do as a public company, invest more in getting closer to your customer? Or are you doing this because you want to harvest? And this is still a cash flow company. You want to take and harvest things, pay as little as you can to keep the stores open and milk it for all it's worth. What happens?
I think it's the first. I think there's things you want to do. I think look what they're doing with investing in private brands. Look at the small format strategy they're putting in place. Look at digitization. And they're doing this in the face of a consumer who's under pressure. So it's hard to get a multiple in a valuation if your top line's not growing. And that's what investors want to see. Investors put multiples on names because of growth. And right now, top line is more stagnant.
So are these investors, I don't know these guys, are these investors who you think are in it for the long haul and really want to be there? They're not somebody that's like a private equity type thing where you take and flip it?
Certainly feels like I don't know them either. I haven't met them. But when they said it's about the real estate, you need strategics who's also about the operations, given the framework this company has.
Yeah, and they say that, they believe they can line up the financing. That's obviously a question. And, the offer came December 1st, right? And Macy's board didn't see the need to necessarily come out and say they got the offer. But in terms of what you think the company, in the absence of a bid, needs to be doing more of right now, because you mentioned department stores don't get much of a multiple. They're kind of valued as, no growth, runoff type businesses. So what should Macy's be doing kind of regardless of an offer?
I think what they've done in terms of pruning the stores and continuing to do that, sell off some of the stores that don't mean as much and invest in where the traffic is, certainly with the hybrid and outdoor malls, and they're getting same-store sales that are above the average in those stores. In addition to look what they're doing with the merchandising, whether it's bringing Nike back, whether it's UGG Home, whether it's investing in luxury. And now you have a new leader at Bloomingdale's while Tony takes the reins of overall Macy's. It's going to be interesting to see the curation of the merchandise that drives sales. They have to be able to continue to gain share of that core consumer.
Yeah, the good news for Macy's is, let's just call it the way it is. It's a massively famous brand. Like, especially obviously in the United States of America. I don't want to speak about international, but inside the United States of America, like Macy's is a insanely famous brand. You say that name to most people and they will know the retail store you're speaking of instantly. And so that's a huge benefit. And I think, it's been a troubled business model. Not a lot of people have wanted to own these mall-based type retailers like a Macy's. But Macy's, I have seen them starting to experiment even here in Vegas with some stores that aren't in a traditional mall. I actually went by one recently, and it's basically a store that's just kind of in like a basic, kind of where a Walmart and Sam's Club and Best Buy type stores are at. And I was like, wow, that's a different strategy. Okay, almost like they want to go a little bit of the Nordstrom Rack type, philosophy.
Hey, Dana, question about the real estate and the real estate value. And I was just looking, Alexander, by the way, I'd said that, Kmart didn't work on the real estate front. Alexander's did. But there's an argument to be made, I think, in the case of Macy's, that it's not like you can turn some of those spaces into apartment buildings or large office spaces, because in some places like New York City, it's unclear whether New York City would allow you to tear it down. And then the question is, if you're not going to tear it down, how much value is actually in that space itself? Because given what's happened to brick and mortar retail. So do you believe, and someone just sent me an email about it, that the real estate unto itself in some ways may be considered overvalued?
I think overall on the real estate side, we're talking about fulfillment. And the goal to be closer to your customer, that's what the stores are all about. And you may not need all the stores, but you certainly, once you're leaving locations, the fact that there is a lack of new development in retail real estate, that's what they have. They have that supply and are able to fulfill. So I think you will see them close stores over the next few years. Right now, they have less than 10 that they plan to close in 2024. But I think they're going to upgrade the retail real estate and be where the traffic is.
Okay, so let's say Macy's does close some stores over the coming years due to this, looks like a buyout situation here, okay? Who picks up that business, right? Because if they close a certain amount of stores, like who picks up that business? A few companies come to mind, right? First one, Amazon. Amazon always comes to mind, right? Amazon continues to build out their clothing and apparel business, and that's just, I think, a business that will just continue to build out over the next 5-10 years, right? Another company that I think of if a Macy's closes down is a stock like Nordstrom, right? Direct beneficiary of that with their department stores from the Nordstrom side. And then on top of that, they obviously have the Nordstrom Rack business as well, right? So that would benefit them. I think about companies like Revolve or other companies that are kind of in the e-commerce space that, are really going after the millennial generation and the next generations up and things like that are really, just different philosophy in terms of shopping and very used to shopping on a phone versus going to an actual store like, the baby boomer generation was and many other previous generations. So yeah, that's who I think would kind of pick up that business. It is interesting, and it does obviously get a lot of people more excited about some of these retail businesses, seeing a potential buyout like that. Okay. All right, next one up here, labor market's cooling off, and then we're going to get to Mike Wilson and why he's bearish in stocks in 2024.
Bob Michelle joins us here at Post 9. Is the Fed going to mess this up, Bob?
I don't think so. I think they want to go out of this year fairly balanced. They don't want to be too dovish and create too loose financial conditions, but they also don't want to be too hawkish and create too much downside here. So they're going to try to thread the needle.
That was the message we got from Powell before the blackout period, right? That there are risks to doing, the risks are more balanced to over tightening or under tightening. He said that there are lags and that we haven't felt the full effect of monetary policy tightening. So you expect a similar message, sort of benign?
Yeah.
Would that be a green light to keep buying everything, bonds and stocks?
Well, look, the long and variable lags are always questionable when they'll hit. What we do know is that we're in nirvana right now. This is as good a soft landing as the Fed could have taken us into. So I, for one, am going to enjoy it. If bonds back up in yield, I'm out there buying. I think this could be a good week for this. You get CPI, you get auctions, you get the Fed. Maybe we'll be able to buy bonds a bit cheaper.
So you're not worried?
I think he said something really important right there, okay? I just want to say this, okay? 100% he just said something super important. Enjoy this time period, right? We finally got a little time period here without any crazy drama. And so you got to just kind of enjoy that for what it is, right? It's been a very tumultuous last several years between Rona, the shutdown, then the money pump, then the crazy inflation. I mean, it's been drama times, so I'm actually welcoming this time as well. Like, however long it's peaceful, the markets are peaceful, the economy is peaceful, and you don't have all this massive insanity going on, like, I'm just enjoying it. And I think everybody out there, we should all just enjoy this time period, man, because it's not always like this, okay? And eventually things will break, and eventually things will go wrong, and eventually this will happen, that will happen, whether that's 6 months from now, 12 months from now, 2 years from now, 3 years from now, 4 years from now. Eventually something's going to happen. And so with this time period we got right now, and maybe for 2024, just enjoy it, man. Enjoy it, because it's not always going to be like this.
Of those event risks as far as the disruption to the bond rally? Auctions, CPI.
I actually want a little bit disruption, maybe get the 10-year towards 4.5 to allow a lot of investors to get in. We talked to a lot of investors, institutional and retail. They're all trying to get into this bond market. Of course, everyone wants to buy at a higher yield. It came and went. I
call this stock market peacetime stock market. It's a peacetime stock market right now. You don't have the Fed doing anything crazy. Unemployment's still in a really good place. It's just we're in a peacetime market right now. VIX is really low. Just got to enjoy it.
So quickly, now we've got a lot of clients that are trying to chase this.
How long does Nirvana keep up for, and what, in your opinion, is going to disturb that? Or most likely to disturb it, I should say.
Well, I do think that there is a rate shock that's been delivered to the system, right? We've had over 500 basis points of rate hikes. It's left things in a very vulnerable position. We're seeing housing has cooled off pretty dramatically. We're looking at the consumer, which is the engine of the U.S. economy, and the bottom 4 quintiles of earners have already burned through most of their excess savings. So unless the Fed is able to find an opportunity to bring down rates over the next 6 months, I think the high level of real yields is what could create more damage going forward.
There was a lot of forensic work done on the jobs number from Friday, basically arguing that we owe much of this year's job creation to government, maybe some private education, healthcare, and leisure hospitality. Do you think that X those things, and I know they're big pillars, but that the job market has slowed to a crawl?
It has slowed, and also you had the returning strike workers. What we like to do is look at a 6-month annualized rate, and the 6-month annualized rate is about 130,000 job creations, which is much different than close to 200,000. And then we went back to 2017, 2019, try to get out of the shadow of COVID. And what we found is job creations were about 164,000. So in fact, the labor market is cooling off. You've still got wages running at about 4%. The Fed would like to see 3.5%. But all of this are sort of the elements of a soft landing.
Well, there are two ways that narrative breaks, I guess, on the risk side. Either inflation spikes back up or flares back up, or the economy weakens worse than expected. Negative payrolls or a few negative retail sales prints. Which do you think is a bigger risk at this point?
Well, of those tail risks, I think to the downside. And I think
on the economy.
On the economy, for sure. And I think what's kind of slipped through the cracks here is quantitative tightening. And the Fed continues to draw down its balance sheet. Of course, when they were expanding their balance sheet and creating money, it got into everything and inflated the price of everything. You would expect that you would see more disinflation and deflation coming as they draw down the balance sheet. And a good starting point is asset prices.
Listen, I'm going to keep saying this, okay? Listen. The scenario that no one's still anticipating and no one's talking about is the consumer getting in a better place in 2024 than they've been in 2023. I'm not hearing any of these guys really ever talk about that. And I'm like, it's so obvious to me. Like, if inflation's dead next year, which it's going to be in 2024, and the consumer has jobs, right? And the consumer has wage increases, which they are, which are going to outstrip inflation. You could see a consumer sentiment that rises quite substantially. You could see savings that start to build, and you could see spending that starts to build all simultaneously versus a 2023 and versus a 2022. So, once again, this is just a scenario that I don't think and nearly enough people are even considering. And I'm like, to me, it's just so obvious. It's just math. It's just data. It's not like it's some crazy prediction. It's literally just look at the data, look at the wage increases that are coming, and then look at what inflation is going to be. And there's a lot of categories that there's going to be deflation, actually, where people are paying less. Gas prices is a good example, right? Gas prices are far less you'll be paying, likely, at least for the wintertime. We'll see how the rest of 24 shakes up, but at least in the wintertime than the previous winter and the previous winter. So, something to factor in.
Again, bearish on a year when everyone else is finding a lot to be bullish about.
Well, look, I think it's really more about the stock picking, which is really what this year has been about, too. The average stock has not done particularly well. It's kind of been a strange year in that regard. Our earnings forecast for the average stock has turned out to be, dead right, and same thing for the average stock. And then we've had these, 10 or 20 or 30 stocks which have done extremely well, and they've done an incredible job of cost cutting in particular, which has driven the major average, the S&P 500 earnings up in a way that we did not project. And that has been the...
You know what? I don't know if I buy this whole, it's only 10, because we heard about the Magnificent Seven. We heard about these 10 stocks. Let's pull up a year-to-date of every single one of my stocks. And let's see how many of them have really performed well or bad or anything alike, okay? Pull up a year-to-date of every single stock, okay? So, Nordstrom, 5% up. Revolve, 31% down, bad stock this year, right? Skyworks Solutions, 18% this year. Very good year for Skyworks. Nike, which is a new position for me, that one's a 1% gainer this year. Wynn Resort's kind of a newer type position for me to really start building out here. That one hasn't moved much, right? Texas Roadhouse, 23% this year. Palantir, 180% this year, right? Target, somewhat of a newer position for me. This one is down about 10%. Avant is down 8.9%. Shopify is up 104% this year. PayPal obviously has had a really tough year as far as the stock goes, down 20%. Elf on a Shelf, this one's up 131% this year. Foot Locker should be pretty down. Foot Locker down 23% this year. Cheesecake Factory, 2.6% up. Mattel, 5% up. Amazon 69.69% up. Tesla stock is up 121%. Meta stock is up 160%. Honest stock this is a crazy one. So Honest stock's down 18%, but if you look at a 1 month on Honest stock, it's up 79%, so that one's a little crazy. Fubo, 87% up this year. Planet should be down. Actually, Planet's up, really? I thought it was a down year for Planet. Planet's up 22% this year, right? So I think that just kind of illustrates, it's a stock picker's market. Some are performing really dang well that have nothing to do with the Magnificent Seven and are getting, double-digit gains this year, right? So, yeah, that's the bottom line. People have just tried to make it out like it's only 7 stocks this year. There's a lot of stocks you can find outside of that have had tremendous years that are up 15, 20, 30, 40, 50, 60, 70, 80% this year that aren't in the Magnificent Seven. So, that's just a little food for thought there.
And we think that dynamic will probably...
But let's be clear. Let's be very clear. It has not been one of those years where every single stock just boomed. And I like that. That makes me feel more comfortable in the market. If every stock is booming this year, then I start to say, okay, we're just in an epic bull market right now. When you have a lot of stocks that are still faltering, which obviously we do, right? Maybe half the market, maybe more than half the market is faltering. That makes me say, okay, I feel comfortable that we have certain stocks that are performing really well. Certain things are going on with those business models and those fundamental cases, and other ones aren't doing so well.
Next year, at least for the first 2 quarters, meaning smaller, lower quality businesses are going to continue to struggle. And then maybe by the second half of next year, when we see actually inflation bottom, ironically, that's when the earnings will come back. And I think that's been the trick. I mean, if you think about it.
That's crazy that he thinks it's not going to be till the second half of the year for inflation to bottom. I think that we're going to bottom out inflation in the first half of the year. And then I think there's actually some level of risk to inflation maybe coming back a little bit in the second half of the year. I'm not super confident in that, but I think that's a serious potential. Let's imagine a scenario where the economy strengthens as 2024 rolls on. Maybe people start feeling better about the commodities market and oil prices, and all of a sudden some commodities start going up substantially, and you never know how that could affect the inflation numbers in the back half of the year. So there's a little...
Inflation's been coming down, which usually is unequivocally good for bond yields. It's also good for disinflationary assets. It's not good for inflationary assets, which are basically small cap stocks and generally average stock. The average stock does better when inflation is actually accelerating. And I think that's been the trick this year. And most people got it wrong, quite frankly, because there were many people recommending, small cap stocks and financials and cyclical stocks, and this just don't work when inflation's coming down.
Mike, what you outlined, though, raises a question about the 4,500 target on the S&P at the end of next year. Is that assuming the big tech can't keep leading, that essentially there might be a recovery?
So this is interesting. A 4,500 number, that's not even that bearish. I mean, we're 4,600, so I'd be down like 100 points. So that would be a market that goes much to nowhere next year, which is, hey, if you know my prediction for next year, I think there's a realistic possibility the S&P 500 doesn't do a lot next year. I think there's a potential out there where maybe the S&P 500 is, up or down 5%. Could be one of those years next year, right? I'm not expecting some sort of boom year in the Qs next year. I'm not expecting some sort of boom year in the S&P 500. If it happens, sweet. I'll gladly welcome it and I'll make a lot of money, but I'm not expecting that for next year, for 2024. So, yeah, man, that's interesting. He's not actually as bearish as you might assume. I mean, if he was really bearish for next year, he'd be like, 3,900, S&P 3,800, something like that.
Other stocks, the smaller caps, but that there will be at least some stasis for the big tech names that account for the lion's share of a lot of indexes.
Well, that's right. I mean, basically, this year has been all about multiple expansion, and this is in a year also when rates have gone up.
Baloney. It hasn't been all about multiple expansion. Look at some of the most impactful, important companies in the world. And look what's going on with their earnings per share. It's just baloney what he's talking about here, in all due respect. Even Apple, look at the Apple's last quarter. I mean, their revenues are nothing, but look at their earnings per share, still growing substantially. Look at Amazon's earnings per share year over year. It's skyrocketing. Look at Meta's earnings per share year over year, skyrocketing. Look at NVIDIA's earnings per share. These are the most important stocks in the stock market, right? Earnings per share, skyrocketing. You go through a lot of these companies, and it's not just multiple expansion. It's just, that's not factual. Like, many of these companies are watching their businesses skyrocket in terms of their profitability, which is not multiple expansion. That's earnings expansion.
For most of the year until recently. So that's a combination that is unusual, as you know. So, our call at the beginning of this year was that rates were going to rates had normalized, quite frankly. They were going to continue to normalize, and then therefore multiples should normalize. So the real difference between our price target this year and what's transpired has been all multiple. We thought the market would close the year.
No, that's a pretty bearish one. JP Morgan at 4,200, that's pretty bearish, right? Down 400 points for the total year, right? Because most years you expect the S&P 500 to go up. But dang, man, looking at these price targets, folks, take a screenshot of this. Looking at these price targets, I like this. I like this a lot. You know why I like this so much? Wall Street's still not bullish on the market. It's going to be a second straight year. Wall Street's not bullish, if not a third straight year. 2022, some went in the year bullish, some went in the bearish. It's arguable if this is 2 straight years or 3 straight years of Wall Street actually not being bullish on the market. If Wall Street was really bullish, a lot of these guys were really bullish, a lot of these big firms were really bullish, they'd have 5,000, 5,200, 5,500 price targets on S&P 500 for next year. When you see these guys, expecting the S&P 500 to be flat, this is not bullish. And I like it when they're not bullish. That makes me feel actually much more comfortable in the market. When everybody on Wall Street starts getting bulled up, that makes me feel a little more uncomfortable, like, something's going to go wrong here. Something's going to happen. Right now, I kind of like this.
17 times earnings, which seems to be a fair multiple in an environment with 10-year yields north of 4% and some sort of level of risk premium.
Whoa.
But instead, multiples.
They went too fast.
With 10-year yields north of 4%.
Okay, so then there's this one. So these are some smaller names, by the way. So Oppenheimer looks like the most bullish on the market. They're 5,200. That's a true bull call there, right? Here you got Deutsche Bank, Citi, BMO, 5100. That's a pretty bullish call. This is an okay call here, Bank of America 5,000. And then this is another bearish call basically there, right?
And some sort
those
of
are smaller names. These are the names that people actually paid a lot more attention to because they're way bigger and more famous names. Goldman Sachs, Wells Fargo, Barclays, Morgan Stanley, JP Morgan. Those are the ones that people actually pay attention to. And they're still very bearish on this market for next year. Interesting.
But instead, multiples are 19 and a half times. So all we're saying, Lisa, is that multiples will adjust this year. Earnings will be fine still for those large cap companies, but the multiple offset probably has them churning in place. And there will be some, obviously, that can continue to deliver better earnings growth, but it won't be all of them. It won't be as broad because that cost-cutting story isn't going to be as easy given the tougher comparisons on that front in 2024.
One reason why people are getting increasingly bullish, led by Ed Yardeni, who's gaming out 6,000 by 2025, is that yields are coming in. People do think the Fed's going to cut, that we are seeing rapid disinflation, and that this is all happening without material weakness, that we actually are seeing a normalization, a transitory, that nobody wants to say the T word. How much do you have to see more to be convinced of that kind of argument, giving a tailwind to all stocks, including those that seem to be at pretty high multiples?
Well, the reality is that we're still out of supply of labor. It's going to be very challenging for us to see a acceleration of growth. We could see a flattening of growth, and that's basically what our economic forecast is, a very unexciting economic backdrop next year, call it 1 to 1.5% GDP growth. It's interesting, not to pick on Ed, but I don't remember Ed talking about fiscal spending the way it's been this year. Nobody did, including us. And that has been the story also of 2023, which has buoyed a lot of the economic data, which ironically has then hurt margin pressure. So, I think 2024 is going to be a year where fiscal spending normalizes, monetary policy normalizes too. We may see some interest rate cuts. And there absolutely will be a transition for businesses that have already gone through that pain. The question is,
you think there's not going to be crazy fiscal spending into an election year? That might be your most interesting prediction of them all, Mr. Mike Wilson.
It be broad? Can it be in a way which takes, multiples higher again, or at least keeps multiples where they are? If you were to ask me, in a broadening, healthier economic environment, multiples will come down as earnings normalize, right? You're not going to pay, a 19, 20 multiple on numbers that are now higher. So we do have a very bullish view on earnings for 2025. We have $266. Okay, should I pay a 20 multiple on that after you've already seen the recovery in earnings? I would argue no, and I think that's going to be the trick in 2024 is balancing once again multiples with where the earnings growth is better and where it's worse. And it should broaden out. It should turn into a broader market, but we think that's a second half story, not a first half story.
Interesting. Yeah, the problem, and this is why it pays to stay invested in the market, because the problem is many times these folks, they want stocks to go up when they want them to go up. They're like, I think this year will be good, 2025, and earnings will be really strong. And so they want stocks to stay at low multiples until you get to that time period. But the market doesn't do that. The market sees the future. So the market's pricing in things before people really understand exactly kind of what's going on there. Same thing happened. When the market started going down substantially in the first half of 2022, earnings were still actually really good for a lot of companies, and people were kind of like, what's going on here? Why is the stocks going down so much? Come on, man. Yeah, the Fed's raising rates, but big deal. Things are strong. And then we saw a huge weakness in earnings in the back half of 2022 and into actually the first quarter of this year in 2023, right? Then the market obviously goes rally mode for the front half of the year. And people are like, what is going on here? This is a fake rally. This is just AI. This is whatever. Just Magnificent Seven. And then all of a sudden you see these company earnings start rolling in, right? And you see a Meta come in and with EPS up 100% plus year over year. You see an NVIDIA come in with, EPS up 1,000% or whatever, crazy, right? You see an Amazon come in with EPS up 100+% year over year. You see an elf on the shelf just growing their bottom line by 200% year over year. And you start going through company after company and you're like, wow. And then some of those companies that were taking big L's have started to improve their profitability profiles. And so some people are saying, well, things are a lot better. Maybe the market knew something, right? Maybe the market knew something ahead of time. And so that's why it pays to stay invested. You see some great opportunities in the market, you pounce on those opportunities, take advantage of those, right? Whatever happens, happens. You can deal with it at that time. The market crashes, okay, pick up stocks for cheap. You want to buy some leaps at that time, okay, do that, right? Market goes parabolic to the moon, and all of a sudden it seems like everybody and their grandma is bullish on the market, and you want to take some profits, and you want to maybe, buy a little more hedging than you usually buy, then perfect. You can do that, right? There will be a moment when it will seem like almost all these Wall Streeters are super bullish on the market. That could come in 2024 at some point in time. I wouldn't bank on it, but it's a potential. I mean, imagine where earnings keep, really ramp up in the first half of the year, right? Then on top of that, imagine a scenario where consumer confidence and small business confidence starts to increase dramatically as 2024 rolls along, and real wages start to tick up substantially, and GDP keeps coming in better than people anticipate. All of a sudden, second half of the year, more and more Wall Streeters got to jump on the bullish bandwagon, more and more and more so, right? And then by maybe the end of the year or going into 2025, it will seem like, geez, is everybody bullish now, right? And then all of a sudden people are putting out, 5,000, 6,000 price targets on the S&P 500 for the following year. So anyways, guys, appreciate you joining me as always. Thank you so much. Much love. Thank you for being subscribed. And by the way, new membership card came in for new members for the private stock group in 2024. Love it. It's a stock. I'm not going to tell you what stock it is, but it's an actual real stock chart there. So much love, folks. Appreciate you, and have a great day.